You do what you do.
Okay, awesome. So, guys, welcome to episode 103. I'm really happy to bring on my friend and colleague, Elan Weintraub. So, Elan is co founder of the Mortgage Outlet. He's a very respected voice in the mortgage space, and his opinion is sought frequently. So, which is why I wanted to bring him back again onto the show. And it turns out that in the coming months, I will be dealing with a mortgage renewal. So I thought the time was perfect. So, Elan, and I realize I may have been mispronouncing your name for years, but welcome back to the show.
Thank you. It's a true pleasure to be here.
So, man, let's just start off with that renewal letter. And I want to emphasize the concepts we talk today, while we will be talking a bit about renewals, totally relevant to anybody exploring a mortgage, even for the first time. But I'll put everybody in my shoes. I got a mortgage renewal letter recently. And for many people, we will take that letter and we will go back to our existing lender. But it turns out that that may not be the best way to get the best product or get the best rate. So, Elan, maybe talk to us about why our existing lenders may not be inclined to give us the best rate. And perhaps into this, we can talk about what are some of the differences in dealing directly with a bank and then also engaging mortgage brokers as well.
Yeah, I mean, it's funny as you were kind of giving that overview. My energy's already up. Like, what an introduction! I have so much to say. The renewal strategy and marketplace has been changing a lot over the last few years. The just starting at the renewal, I would take a step back and a renewal is a great forced time to do a checkpoint. And a checkpoint to me means, is your career stable? Is your family life stable? Are your financial needs changing? And looking at it more broadly. Because oftentimes, well, again, when I look at a bank or a lender, they will take a borrower like you and some statistician is going to put you into a matrix. And maybe half the time they'll give you a really good rate, and half the time they'll give you a really bad rate. And it's all based on statistics and lifetime value and all these wonderful things. So a lot of times I have clients like you that might come to me and they might say, hey, Elan, this is the rate that they gave me. And I'm like, wow, that's a great rate. Like, that's great. You should take it. But then half the time you're in oh, you got the bad bucket and you're in the bad rates. So like right there, what's the starting point? But there's a lot of games and, banks are in it to make money, right? That's what they're there for. Inertia is a very powerful force. They might not want to give you their best rates up front because if you're with bank A and you switch to bank B, they know I'm with bank A and I got a credit card with bank A and I know the guy there. So they're using inertia against you, as they should, right? They know that you're not going to kind of leave and I tell my clients this, I would tell you this, I can save you 20 bucks a month, but I'm going to need a lot of paperwork. Is it worth your time? You're going to say no. Now, the other part of renewal that's really important is, hey, Elan, I'm planning to buy a cottage, or I'm retiring, or my kids are getting married and going to university, or, my cash flow is a little tight. So that would be more of a, don't just renew, but let's talk about your monthly payment. Let's talk about your needs, your cottage. Now, again, are you with a small lender or a big lender? I like big lenders. I like big banks. Frankly speaking, for physicians, big banks are the way to go, or large credit unions or insurance companies. And the reason why is physicians have complex needs. They have a lot of income. They have businesses. They have all these things. A small little lender does not have the robustness of a big bank or a big credit union or a big insurance company. So when you say to me, hey, Elan, I got this renewal at this rate, and you tell me you're at a very small lender, I'll be like, I can get you that rate or maybe a little bit more, but this lender will give you all these other things. And let me be very specific. Number one, I'm a huge advocate of lines of credit. Now, you can get a medical line of credit, which is unsecured, but also a home equity line of credit. Now, when I'm going to talk about what is a home equity line of credit. Well, we all know it's just accessing money and equity from your home. But there's a really nerdy mortgage concept that I love, and it's called the paradox of credit. What is the paradox of credit? The best time to ask me for money is when you don't need it. If you say, hey, Elan, life is good, income is good, family's good, everything is good, amazing time to ask me for money. If you're like, Elan, I'm getting divorced and my basement flooded and, I got laid off from my job and I had to take some losses in my medical corp. By the way, I need money. Way worse. So, number one, paradox of credit, get money when you don't need it. But also on the flip side, bad things happen, but good things happen. Hey, Elon, I could buy into a medical practice and I need the money. You have the line of credit ready to go. You're ready to go. So again, are you at a small lender? Are you at a big lender? Are your needs changing? What's your rate? What's your cash flow? Now, here's another really cool one, and I think you're going to like this a lot. Let's
Okay.
say, and again, obviously the main focus here is physicians. Let's say you're buying, a home, 2.5, 3.5, $4.5 million. You've been working hard, building your career, building your business. You're buying a luxury home. And a lot of physicians and a lot of people, they're like, I want a 25-year amortization. I want to pay down this mortgage as quickly as possible. I get that. So my concept is take a 30-year amortization, make your monthly payment as low as possible. Why do I want your monthly payment to be low as possible? Because if you have a medical corporation and you're paying yourself $300,000 a year, well, now you could pay yourself $250,000 a year because your mortgage payments are lower. So you're taking less out of your corp and saving taxes because your amortization is 30 years. Now, obviously, you got to talk with your accountant on anything related to tax. But what I'm doing is keeping more money in your corp. So again, it's broader, whereas your renewal, and again, this is the thing with renewals. If you had a 30-year AM 5 years ago, and 5 years have gone by, most of the time, your 30-year amortization will now be 25 years on renewal. So I would
Yep.
stretch it back out to 30, not to avoid that, not to, not pay the debt back, but very simply to keep profits in your corp, paying yourself as little as possible. So again, like you could see this renewal thing, like, and there's more and more and more, but there's so much to talk about. Actually, I
Yeah.
want I want to say one
Yeah.
other thing.
Go for it.
One thing I always say is always go back to your bank. Start off with your bank. You're with Big Bank A. What did they offer you? If they offer you an amazing rate and you've got a good corporate setup
Okay.
and you have the line of credit, the last thing I want to do is ask you for all these documents to save you. So start off with the existing lender. But here's another catch. There's always a catch. A lot of people right now have a 5-year rate of, let's say, 1.49%. Now the bank is going to say, hey, we can early renew you at 3.69%. But that rate is effective today. Why would you switch your 1.49% to 3.69 today? Makes zero sense. But the bank wants to switch you, number one, because they have your loyalty, your new 5 year. But number two, they're taking you out of a 1.49 and putting you in a one. And then they play another game, which is I can't hold the rate for you for the next 4 months. I can only give you this rate today. So what I would say, no, I'm serious. What I would say
Yeah.
to that person is, I'm happy to hold the rate. You're not going to switch today for sure. And then in 4 months, if my rates and offers are better, great. And if not, you just stay with your bank and you're good. But I know I've said a lot and I know you're waiting to ask me some questions. There's just obviously so much to talk about.
Yeah, I've got a lot of questions.
Go
So
for it.
let's talk about amortization first, and I can start this off with another story. So back in 2021, when I was refinancing, I made the decision of jumping out in front of a dumpster truck and trying to like just scavenge for pennies because I had a great fixed rate offer and I was just like, oh my God, they've given me an even better variable rate offer. Could you believe it? I actually went down the variable route. So now there are going to be people who enjoyed that, let's say 1.5, 1.6% for 5 years, which is just unbelievable when you think about it. And now they're going to be renewing at a much higher rate. So I can see the argument there for maybe extending your amortization, reducing your financial commitments per month to the house, and also leaving behind more in the corporation. But that's maybe at the expense of, listen, I like to pay down my mortgage faster. It's just one of those things that helps me sleep a bit better at night. It's something within my control. And it's also, Elan, it's something that I tend to do a little bit more. Let's say when I look at, okay, what are the investment opportunities in front of me? Let's say the markets are ripping at all-time highs. I invest in some ETFs, but more so in stocks. I don't see a lot of opportunities. For me, paying down the mortgage is like a no-brainer in that scenario. And it also helps me to sleep better at night. So maybe in terms of extending amortization, can you talk a bit more about, you've talked about the arguments for, maybe some against. I just
Yeah.
want to capture it completely.
Yeah, I mean, again, there's so many questions in there. So again, there's a really nerdy concept. It's called the risk-adjusted rate of return. So risk-adjusted rate of return. So I'll use two examples. 2, 3 years ago, let's just say interest rates were 6%. And people were saying, should I invest or should I pay down my mortgage? Definitely pay down your mortgage because, sorry, let me correct my term. After tax, risk adjusted rate of return. So if I rewind 2, 3 years ago, and let's say you had a really good year and you say, hey, Elon, I have $100,000. Should I dump it into my mortgage or should I invest? So if you take that 100,000 and put it right into your mortgage, your guaranteed rate of return is 6% because that's the interest rate on your, but you're using after tax dollars on your mortgage.
Hmm.
So it's almost really like a 10% return less taxes. And then when you invest in the stock market, you could get a 10% return, but you could get a minus 10% return. So there's a risk involved. So if interest rates are 6%, I would absolutely agree, put the money in your mortgage. But now it's a bit of an interesting time that if rates are 4%, 3%, you need to make a business decision and a psychology decision. And it's funny you said that. It is a psychology decision. There's maybe a mathematical answer based on trends and analysis, but again, I'll give you a quick example. Clients say to me, Elon, should I go fix your variable? And then I talk to them and I'm like, so what I'm hearing is if you take a variable rate, you're going to be stressed out for the next 5 years. And they say, yes, I will. I'm going to I'm going to watch the news every day. I'm going to be, no,
Yeah.
no. But then I'm
Yeah.
going to say, even if I tell you that probabilistically, which is all I can really tell you, I can't guarantee the future. If I say probabilistically, variable is the way to go, but you're going to be stressed out for the next 5 years, like that's an easy answer. So like you said, you want to sleep at night, and there are people, they're like, I want to pay off my mortgage, like done. But I want to go back there, and there's an expression, there is a way to kind of suck and blow at the same time. And what I mean by that is I'm a big believer in take other things being equal. If it's a very small mortgage, it's different. But if it's like $1 million, if it's 2 million plus, always take. I don't like the word always, so I say it with a little bit. Always take a 30-year M. But you can call your bank, you can call your lender, and let's just say your payment is 10,000 a month. Let's just say that's what it is with a 30-year M, and you say, I know my payment is 10,000 a month. I want to make it bi-weekly. And now it's 5,000 bi-weekly or whatever, a little more, whatever. Right there, you're mathematically taking your M from 30 years to 27 years
Mm.
bi-weekly. And then let's say you get a bonus at work or you've got a really good year and you have, a $50,000 bonus. You can dump it right into your mortgage. So now your 27 years becomes 25. But the reason I always say take a 30-year AM is you are obligating yourself to the bank or to the lender for as little as possible with your option to give them more, right? Actually, let me give you a funny example. And again, this is why I say the word always. Let's say you're building your career and then one day someone calls you and they're like, we want you to head up our AI radiology practice. And the salary is 70,000 a year, but you're going to have options and you're the chief medical officer. Guess what? your cash flow is massively disrupted. But if you had a 25 or a 20-year AM and you start going to the bank, oh, I have this, that's not a good place to be in. The 5-year, again, I'm oversimplifying, the
Mm-hmm.
5-year agreement is a contract.
Mm-hmm.
But if you take that 30-year AM, you can increase your payments, use your bonuses, do bi-weekly to mathematically get you to 25, 22, 18 years. But if you get that phone call and take a $70,000 a year
Mm-hmm.
AI chief medical officer job, you're okay to live your life. Or God forbid someone gets injured, or maybe your spouse has a baby and they're off. And so it's all about cash flow management, which is why I'm in favor. Again, we're all talking, this is all general, but why I always push for the 30-year.
Okay. One last question on amortization. Let's say I start with a 30-year amortization
Mm-hmm.
and then my 5-year term comes to an end.
Yeah,
Theoretically, I'm down to 25 years.
yeah,
But when I re-approach the lender, can I go
yeah.
back to 30 years?
So, great question. The very simple answer is it depends. I'm going to say most of the time, no. There might be times when yes. Most of the time, no.
Okay. Now, just in terms of paying down the mortgage,
Yeah,
I want to make sure everybody understands this. And I'm going to use some hypothetical numbers here because let's say you have $400,000 left over on your mortgage. And let's say the interest rate that you're paying is 4%. If you make a $100,000 prepayment, you're saving 4% of interest on that 100K. So you're saving $4,000. But then you've knocked down the residual principal by 100,000 down to 300,000. So over the next year, instead of paying $16,000 in interest on the 400K, you're paying 12,000, right? Like so this is why for me the rate of return is more than just 4%, but I want to make sure that I have explained that correctly. What do you think?
like conceptually, yes, there's a little bit of, because it's a blended payment, so it's not simple interest. But here's how I would look at it. In the long run, let's use your example. Elan, I have 100,000. Should I put it into my mortgage or should I invest it? If you feel that in the long run you will yield, a 7 to 8% return in the long run, it might make sense for you to not pay it into the mortgage, because if you're earning, 7 to 8% year over year, but your cost of having that money is only 4%, you are getting that spread in the long run. But again, that's a personal decision, a risk decision, long run versus short run decision. That 4% is guaranteed. The 7% is not. So there's that element as well.
Let's move on to some key questions we may want to ask at renewal time. And this is
Yes.
beyond the typical question. So, this next point comes from a story too. I reached out to one of my lenders on a mortgage that I have, and I asked them the interest that I'm paying each month. It's not exactly what I expected based on this online mortgage calculator.
Sure.
And then they came back to me and they said, oh, Yathan, that's because of the way or the frequency at which the interest is compounded. And for me,
Yes.
that was a totally novel concept.
Yes.
And then after I dug into it a bit more, it turns out that not every 4% mortgage is exactly the same because of how frequently the
Yeah.
interest is compounded. So, can you explain to us this concept and
Sure.
maybe even give us an example of is this significant in today's landscape? Does it
Yeah.
really impact things over a 5-year term with current rates?
Yeah, that's a great question. So, by law, fixed rates are compounded, I believe it's either annually or semi annually, and that's it. So, in general, fixed rates are all the same. Like big bank A, B, C, they're all the same. Now, what some banks do, and this is one micro example of, frankly, again, we talked about the fact that I love medical analogies. I don't know anything about medicine, but I love medical analogy. I tell my clients always get a second opinion, because your bank, again, when you walk into a BMW dealership, what kind of car are they going to sell you? Only a BMW. They're not going to tell you that an Audi is on sale. They're not going to tell you that a Jeep is better for your cottage. They're not going to tell you that a Tesla has, a different fuel system. Always get a second opinion. So, like, that's a big part. So this is a micro fine print And every bank has 30 different levels of fine print. And 90% of the time, the fine print is irrelevant, but it's not relevant unless it is relevant. So, on that note, fixed rates are pretty much the same everywhere. That's by law. Variable rates, and I'll use RBC as an example, RBC compounds variable rates based on the payment frequency. So what that means is if I have a 4% rate at, let's just say, Scotia and a 4% rate at RBC, and I pay my mortgage weekly, because like we were talking about, you pay bi-weekly, you pay weekly, you're going to pay it down faster. So Scotiabank will compound the interest semi-annually. RBC is going to compound the interest weekly. And
Wow.
what compounding is, and as an compounding is this in this is it's an I'm actually trying to internalize it. I believe Einstein called compounding the eighth wonder of the world.
100%.
When you really dig into it, and I'm still like really trying to get it into my bones, compounding your career. You talked about your 10 years and more. That's compounding, right? It's interest on interest, it's payment on payment. So RBC is saying, oh, well, every week we're going to add interest on interest on interest. So a 4% RBC variable rate compounded weekly is not the same as a 4% Scotia rate. That RBC rate might be 4.05, 4.1, 4.15, again, depending on the exact specifics. But we've all been trained by everyone, what's the rate, what's the rate, what's the rate? And rate is critical, but you need the broader context. And that's just one example. There are many, many examples.
That is fascinating. Thank you for those examples.
Yeah.
Let's go on to
Actually, no, no.
prepayments.
I
Yeah.
want to go back
Yeah. Yeah.
before I forget. This might be relevant for you. And again, this I could talk about this for an hour, but I won't. A lot of people like you, a lot of people like you listen to the chief economist, listen to all the news outlets, listen to all the experts, listen to the Bank of Canada. Get a variable rate, rates will be low for a long time. Now, very quickly, actually, this is also very important. You could see how everything is important. Let me go back to that example of Scotiabank versus RBC on the variable rate side. So we talked about how RBC in that one dimension is worse because they compound based on payment frequency. Variable rate mortgage, variable rate, all the same. But there are two kinds of variable rate mortgages. There's what's called an ARM and a VERM. An ARM is an adjustable rate mortgage, and a VERM is a variable rate mortgage. So what does that mean in English? 3, 4, 5 years ago, you got a Scotia variable rate mortgage, which is an ARM, an adjustable rate. Your payment was $3,000 a month. Rates went up. Your payment is now $3,300. Now it's $3,500. Now it's $3,800. Now it's $4,000 because rates kept going up. So literally every month, every 2 months, Scotia was, hey, your payment is now $3,200. Your payment is now $3,600. RBC and a lot of the other banks, they're like, don't worry, your payment is still $3,000. Don't worry, your payment is $3,000. But all of that interest is accruing in the background, but your payment was the same. So right there, that's a massive difference between lenders in how the payment is applied. But when rates are going down, Scotia is going to lower your monthly payments. RBC will keep it flat. But the thing I wanted to bring out, and I'm not going to talk about it, is, which you might have felt, is trigger rate and trigger point. So RBC,
I felt it. I
no,
did
I know, but
experience it.
again,
Yeah. Yeah.
that's
Yeah.
a 1 hour topic. I'm not going to
Yeah.
get into it,
Yeah. Yeah.
but on a very simple level, your payment is 3,000. Your payment is 3,000. Rates keep going up. Eventually, RBC is going to say, whoa, 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 like you've got, like, there's no way. Now we're forced. You've gone so far behind. We're forced to raise your payment. So I'm tying this in to the question about renewals. There are people that have a 99-year amortization at renewal because no, like
I
this is
know. I've
it's
heard
all
this.
math, and I'm glad you're laughing. It means you get it.
Yeah. Yeah.
There are people, and again, you're asking about renewals. So there are people that are like, cool, you're up for renewal. You missed $50,000 of accrued interest. So what are your options? Number one, give me a $50,000 balloon payment. Just give it to me. Number two, I'll throw that 50,000 into the renewal, but now all of a sudden your monthly payments are going to skyrocket because now you've borrowed a lot more. So
Mm.
again, there's a lot even within the concept. And again, one of the biggest mistakes among many, people say, what's your rate? What's your rate? What's your rate? And I'm like, you've got like, what's your new payment? And there's this $50,000 balloon that they've come in. Your AM got went from 30 to 25. Your payment might be thousands of dollars more. So you got to look at the rate, the payment, your current needs, the future needs. That's why I say always, always, always get a second opinion.
I'm really happy you mentioned that, Elan,
Yeah.
because I can tell you with one of my rental properties too, I did experience a ballooning of that amortization to about 65 years.
Yeah.
And then fortunately, with the rate cuts, it came down
Yep.
dramatically. Now
Yep.
it's normalized. Now we're
Yep.
probably even a bit further ahead of schedule.
Yeah.
Now let's move on to prepayment options. I think this,
Sure.
for people who are incorporated, who have a bit more
Yes.
control over their cash flow, this
Yes.
can be an
Yes.
important question to ask. On my last mortgage for our home, it turned
Yeah.
out that we did have a 20% prepayment
Yeah.
privilege,
Yeah.
but not all mortgages are built the same this way. Can you
That's
tell
right.
us a bit about this and the range that
Sure.
we can expect?
Yeah, so again, generally physicians should only be dealing with banks, large credit unions, large insurance companies. I would say at a minimum, it's 10% of the original principal up to 20%. But
Hmm.
again, and this goes back to what I was saying earlier, there's always tricks. And I'm going to talk very specifically about RBC. Now, RBC lets you make a 10% prepayment only once per year. Other banks might do 20, 15 or 20% anytime. So even if you're, let's say you are a physician and you have some extra money and maybe your spouse gets a bonus at work in March, if RBC only lets you make a prepayment on October the 3rd and you get that money from your spouse in March, you're literally sitting on that money until October the 3rd. Other banks will let you make the payment whenever you want. And a lot of them will do 15 or 20%. As your income goes up, as flexibility goes up, you want that ability to make the payment whenever you want. Now, I'll be even more specific. Some banks use a calendar year, so 20% per calendar year. Others use what I call a mortgage anniversary year. So if you buy your house on July 15th, then on July 14th you can make a prepayment, on July 16th you can make a payment. You need to know that. And again, especially if you're buying and selling real estate, there are times where I've said to a client, and again, you need a little bit of luck, but you also need a lot of expertise. You need to go to your bank on July the 14th, make a massive prepayment, then go in on the 17th, make another massive prepayment, which will lower your penalties. So again, it's all part of that broad, and mortgages have become more and more complex, more technical, more intricate. So to your point, number one, 10% versus 20%. Number two, is it only one day per year or is it many times as you want? And number three, is it calendar year or is it mortgage anniversary year? Actually, one
That,
other thing, sorry, going
yeah,
back. If you have a mortgage at 1.49%, and this is, again, psychology versus finance, which is an amazing topic, I would say never prepay your mortgage. Why would you prepay your mortgage at 1.49%? But I have clients that say to me, Elan, no, I want to be mortgage free. I'm taking advantage. So they're literally going and prepaying their mortgage at 1.49, which I would argue is a horrible thing to do financially.
yeah, I
But
agree with that.
again,
I agree.
and again, I'll use another medical analogy. I might be the expert, you might be the physician, but your patient, they're going to decide what they do. You might say, I want you to diet and exercise, and they might like smoke and eat fast food. It's their prerogative. You can only do what you recommend. It's the same with me. I would say don't prepay your mortgage at 149, and they're like, no, Elon, too much stress, I'm paying it. That's fine. I'm okay with that. As long
Yeah, I
as they're
hear you.
making an informed decision.
I hear you. Now, that one time a year
Yes.
prepayment with RBC, is that an RBC specific phenomenon?
I believe, let me think about this.
And part two to the question is,
I believe it is. It
yeah,
might be. I believe it is maybe National Bank, but I believe the other banks are. First of all, the other banks are 15 to 20%, and then I believe they are as many times as you want, and I believe RBC compounds variable. Based on the payment frequency. Don't get me wrong, RBC is an excellent lender. Like they're one of the big banks, they treat their physicians very well. As long as you are making an informed decision. And again, if you and your spouse have a bonus structure or a payout, a fiscal year end in September and a bonus in RSP in March, that might be a very important feature for you. And therefore, again, you're getting a Jeep, but you need a minivan or an SUV or a Ferrari. A Jeep isn't bad as long as you know you're getting a Jeep. So, like, again, RBC is an outstanding lender. You just need to be informed of the relevant clauses and calculations.
is there one lender in the group that stands out as being the most flexible when it comes to prepayment, or would you kind of lump all those other banks into one?
On the margins, like most of them are 15 to 20%. And again, like
Hmm.
if you have a million, let's also be practical. If you have $1 million mortgage, 20% of that is $200,000. Like most people don't fundamentally have $200,000 every year, and you can increase your payment. So there becomes a certain point where there's massive diminishing returns. I actually think the ability of doing it, as many times as you want, whenever you want, is actually much more important. And again, let's say your 1 year anniversary date is February 3rd, but you get your money on March 18th. You're gonna have to wait 11 months to put the money into that mortgage.
Okay, let's move on to good debt and bad debt. Elon, maybe you can shed some light on tax efficient strategies for
Yes.
people who have the ability to do so
Yeah.
using a HELOC when it comes
Yes.
to their mortgages.
Yeah, I mean, again, another great question. I'm going to say, I actually feel like there's a lot of buzz and a lot of sexiness with all these big, I like to keep things very simple and then we get to the complexity when we need to. Smith maneuver, cash damming, laddering. And I'll be honest with you, I think these can work in extremely one-off scenarios, but I actually feel like it's the industry trying to like sell things that, maybe don't, they're trying to like sell so much just to get conversations going that I don't necessarily fundamentally believe in some of them for most people. And let me give you a very specific example. Again, without getting into all of the intricacies, with a Smith maneuver, if you pay your mortgage down and you re-borrow the money and you use that money for businesses or for properties, you can write off the interest. But here's where the math gets a little shady for me. If you came to me today and asked me for a mortgage, let's just say I could get you a rate of 3.7%. But if you re-borrow that money from your line of credit, which is what the Smith maneuver is, most line of credits today are at 4.75%. Most lines of credit. So if you have a 3.7 rate and you re-borrow the money at 4.7, yeah, there's some tax efficiencies, but there's a 1% spread in your cost of borrowing. So again, you're starting to introduce a lot of complexity. Again, if it's a smaller mortgage or it might not be worth introducing all of that complexity. But if the line of credit was at 3.7 and your mortgage interest rate was 3.7, it could actually become much more attractive. But again, all this stuff, it can work. It's a really good conversation to have on a one-on-one basis. But for most people, I don't necessarily think it's the silver bullet that people think it is.
Yeah, I do tend to agree with you here. I was looking into and studying the Smith maneuver recently, but my understanding is that this is a strategy that is really meant to be deployed over the long term.
Yeah,
And it's really a three-pronged approach. Like
yeah,
you will end up growing your investments over time. You will over time end up maybe trimming a few years off your mortgage, and you will be reducing your tax through tax deductions, but it's not going to happen in a year, in 2 years, in 3 years. Like this is
Compounding.
usually well over a decade. We're talking like 1 to 2 decades. So I personally decided for myself it's not worth
This
really
is
looking
what I'm
into.
saying.
But Elan, I want to make sure though, is there anything in this bucket that you were like, oh wow, strongly consider this, or still more a case by case basis?
Extreme case by case, and I'm not, again, like in general, it took me many years to learn a very important answer. I have an answer to every mortgage question. The answer is it depends.
Okay.
So like
Okay.
generically,
Yeah.
I think that this is a lot of buzz and people trying to sell all kinds of fancy stuff. I actually think, and this is an interesting theme, but the more complex a financial product is, the more I dislike it and I distrust it. And that's just my own, again, psychology. I'm not saying it's wrong or right. But I want to we talked briefly about laddering, and I want to
Mhm.
mention something very specific about laddering.
I have one quick
Go,
question on a
go.
HELOC before
Yes,
laddering. I
yes.
just want to ask that. Is there a way to structure a HELOC in such a way that, let's say, somebody is interested in something like the Smith maneuver,
Yep,
case by case basis,
yep.
obviously, but let's say you prepay the mortgage $50,000. Can you then go in and just extract 50,000 right away from a HELOC, even in the early days? Like, is it possible
Yeah,
to structure it, or
yeah.
only once you have accumulated enough HELOC room or withdrawal ability?
Again, the answer is going to be it depends, but in general, you should be able to re-advance it. And that's something that would be really like you want to make sure because different lenders have different policies and there's a bunch of actually new regulations related to this, but in general, you should be able to re-advance it.
Okay, let's go to mortgage laddering. You wanted to
Yes,
talk about this. Go ahead.
sure. So, first of all, what is laddering? And I'll use an investment parallel. The investment parallel is dollar cost averaging. So let's say you win the lottery, you have $1 million. Do you go out and buy $1 million of Microsoft today? Well, a lot of investment advisor would say, don't do that because what if tomorrow they have a bad earnings call and the shares go down by 30%? So the dollar cost averaging on the asset side is, put 200,000 in Microsoft today and 200,000 in a month and 200,000 in a month or whatever your kind of strategy is for dollar cost averaging. Laddering is actually the same concept, but on the liability side, not the asset side. So what does laddering mean? Let's just say I need $1 million mortgage today. I'm going to take a 5-year term at 200,000 and a 4-year term at 200,000 and a 3-year term at 200,000 and a 2-year term at 200,000 and a 1-year term at 200,000. So that way, if there's any kind of interest rate shock, I'm theoretically diversifying or dollar cost averaging my cost of borrowing. But what people don't think about is the downside. So what is the downside to laddering? Well, number one, the rates are not all the same. So like if you take, a lot of my clients are taking a 3-year rate now, let's just say it's 3.7%. A 1-year rate right now might be 4.5 to 5.5%. So right there, you're paying more for that 1 year. That's based on bond yields and all these wonderful things. So that's one problem is you're not sort of taking that 3-year low rate. You're paying a lot more. But here's the thing, and again, this is, I believe in simplicity and first principles. Banks want to tie you up. They use the word loyalty, I use the word prisoner. And that's a marketing word. That's like an MBA word. What does the word prisoner mean? When you get a cell phone contract with Rogers for 3 years, you are 100% loyal to Rogers. Why? Because if you leave, there's a massive penalty. So you're loyal, but it's not emotional loyalty, it's behavioral loyalty. You are a prisoner to Rogers. So if you ladder up with a bank, how can you ever leave that bank? Because you're going to have all these penalties. The banks are always going to have, by definition, by construct, you're going to have 4 mortgages that are not maturing. If you have a 3-year term, it's done, and then I can shop you around. But if you have a 1-year, a 2-year, a 3-year, a 4-year, a 5-year, 80% of your mortgages are not renewing, and it will be extremely hard to take you to a new lender that has some crazy promotion because you're stuck with them. So again, I love the word. It's an MBA word, but the word is prisoner. You are their prisoner because you cannot leave them.
And I would say the downside of this strategy, in addition to what you just discussed, is also like a lot of mortgages, a lot of moving parts. right? It's a much more active
Yes,
strategy in
yes,
my view
yes.
too. That may not work
Great point.
for some people.
Yeah.
Let's talk about mortgage best practices. You already touched on changing your payments from monthly to biweekly if you want to
Well,
take simple actions to,
accelerated
yeah,
biweekly or even accelerated weekly if you can.
okay.
Yeah.
Yeah. Any other low hanging fruit to pay off the mortgage a bit faster?
I mean, that's a big one. Again, if you find you have extra cash flow and the extra, well, so I would take a step back. I think this decision is in the context of your overall financial picture. And again, I have tons of medical analogies. If you come to me with a broken arm, you know, well, I want an MRI, CAT scan, EKG, blood pressure. I want everything because I want to know if you need, no, I'm serious. If you need surgery, I want to know if you're diabetic or if you have cardiology issues or whatever. So I would never advise someone in the pure silo of mortgages. What if they have credit card debt? What if they're about to, give their kids $100,000 for a down payment? So the first thing is what is going on financially, income, assets, family, goals, plans, aspirations, all of that. And then, and again, I have clients when I talk about the renewal process, Elan, I make a lot of money. I don't have any goals. Everything is stable, stable, stable. Like that's a very different conversation than I might do this and I might do that. And we're thinking about retiring. That's a very different strategy. So, probably the first tip, and again, like for a physician, look at globally what's going on. And where can you optimize your debt? If you've got a 149 rate, I would say talk with your accountant, talk with your financial advisor, but I would say don't pay down your mortgage or have that discussion, make an informed decision. And then when we're like 5 layers in and it's like, Elon, I got my mortgage 2 years ago, it's a 6% rate, then okay, let's make lump sums, let's pay accelerated weekly. If you find that you've got extra money, like I'll tell you something, and this is behavior psychology. I'm a set it and forget it guy. I don't look at my stocks every day. So it's like if your monthly payment is 3,000 a month and you've got a lot of extra cash, just call the bank and say I want to change it to 3,600, set it and forget it. Done. Like I love that because like you just said, you're not actively managing. It's a mortgage, it's boring,
Mhm.
right? So like that would be, if you can increase your payments, use your lump sums. There is this option I call the Canadian option, which is you contribute to your RSPs, you get a tax refund, and you take the tax refund and put it into your mortgage. So again, there's all these things that can really help you pay your mortgage down faster. And I actually just did a 5-part series on my social, but I talk about paying your mortgage down faster.
So as we wrap up, I do see a lot of mortgages for doctors, medical professionals, like
Yes.
that term gets thrown around a lot, but
Yes.
I'm curious, you doing what you do, is there anything for us in this space that is truly standing out today?
I mean, I don't think there's anything standing out other than you can generally get, a great rate. You can generally borrow whatever you want. So it's not that side. To me, it's more like if you're getting a BMW, should you maybe have gotten the Audi? And a lot of one of the traps is a lot of physicians, whether it's in medical school or coming out, they align with one bank or one lender, and they're like, yeah, they're good, they're good. And again, it's just that informed decision. It's that 5-minute conversation of like, well, wait a minute, you should think about this, you should think about that. Again, the other thing is, as are you kind of like, I just want one house and I'm pretty stable, or I have aspirations to build a property ladder or to do all these things? The more complexity you have, the more each lender, because let me say something very clear. All the banks are 96% the same, right? And let me be even more clear. Google RBC sucks. Google Scotiabank sucks. Google TD sucks. Google CIBC is amazing. They're all amazing and they're all terrible. Like that's just they're big banks. They're part of our society and all that stuff. But it's like Do you know what you need to know to make the right decision? And in general, that's like a 5 minute conversation a lot of times.
Now, what is the lowest rate you've seen these days?
I would say like mid threes, so like well three like 349 to 369, but maybe a bit higher. And again, there's always promotions, there's always things going on. There's been some promotions that just ended, so the rates might be a little bit closer to the mid or high threes. But again, there's a funny analogy here. When people ask me what's your lowest rate, which is absolutely the right question, it's kind of like me saying, well, how much is a BMW? You could buy a $40,000 one and a 200,000. So let's make sure we're talking about the right thing, because there are certain mortgages where I have lower rates, but I would never recommend them to you. I would never give them to a friend, a family member. Be careful. You get what you pay for. I like, especially for physicians, big, robust lenders. They handle the complexity, they handle the changing needs, starting a practice, buying and selling real estate, building a property ladder. They're just more geared up for you.
Now, Elan, how do people follow you, the work that you do, and the content that you post? And then finally, some
Sure.
closing thoughts as well, if you'd like.
Appreciate that. Yeah. So I try to be active on social media. I try to be opinionated, be very practical, put my own flavor on it. I mean, if you've liked this conversation, I am me, like this is who I am. So I'm very active on Facebook, LinkedIn, Instagram, and I'm trying to get on some of the other ones. I'm going to try to start uploading some stuff on YouTube. Like I have a 1 hour seminar, Never Renew Your Mortgage. It's a 1 hour seminar about renewals. I have one, we didn't talk about this, but new construction is imploding. People bought condos in 2022 for, $1,700 a square foot. 4 years later, it's ready and it's appraising for $300,000 less. So I have, help I can't close on my new construction purchase. So I'm going to try starting to put that stuff on YouTube. But the simple answer is Facebook, LinkedIn, Instagram for now. And again, as you can tell, I love talking about mortgages. So
Yeah, well,
yeah,
that's why I like to bring you on the show, and that
thank
you
you.
are opinionated but very open, and you are you, Elan. So,
Thank
man,
you.
thank you again for making time for us today and educating us.
Thanks so much.
Okay, man, take care.